Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next presentation from Lotus Resources Limited. Please note you can submit questions in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Keith Bowes, Managing Director of Lotus Resources Limited, which trades on the OTCQB venture market under the symbol LTSRF and on the ASX under the symbol LOT. Welcome, Keith.
Hi, my name is Keith Bowes, and I'm the Managing Director for Lotus Resources. Lotus Resources is a company that owns two uranium assets, one of which is located in Malawi, Kalakera Uranium Project, and the other one, the Letlhakane Uranium Project, which is located in Botswana. My presentation today, what I'd like to talk about is the recent acquisition of the Letlhakane project and why we like that Letlhakane project, but also give an update to the audience of what's been happening with regard to our Kalakera project, how we see those two projects integrating, and what the future work program is for each of those projects. Before I get into the detailed presentation, of course, just an important notice here with regard to forward-looking statements that I may make during the presentation. This is all available on our website if people would like to read it in more detail. So just to start off with a really high-level bit of corporate information about Lotus Resources. So Lotus Resources as a company is listed on the Australian Stock Exchange with its OTC listing as well. As of today, our current share price is 28 Australian cents per share, which values us at somewhere around 480 million Australian dollars, or thereabouts $320 million. The company itself has almost $16 million in cash as of the end of the September quarter, and we have zero debt at this point in time. Just having a look at our register, who are the main owners of our shares, you'll see that according to the pie chart on the left-hand side there, we do have a significant retail shareholder base. About 50% of our shares are held by retail, of which the majority of those are effectively Australian retail shareholders. The ETFs are starting to buy into our stock as well. About 10% of our stock is held by the ETFs, and a further 16 or 17% is held by the institutions. Management as a group also owns a significant portion of the stock. So just talk a little bit about Lotus and what its intentions are. So Lotus as a company is very much uranium focused. We want to be a leading uranium player within the Southern African market. We believe we have two assets that will allow us to do that. The production-ready Kalakera project, as I mentioned, as well as our large-scale growth project being the Letlhakane. We are one of the largest uranium resources on the ASX. In fact, our 241 million pounds of resource that we have post the acquisition of Letlhakane places us as the third largest uranium resource on the ASX stock exchange. The two projects, as I've mentioned, give us a long life and diversified asset base as well moving forward. And I'll talk a little bit about how those two projects exist together in terms of providing this long life. I'm sure the market or the people on this call will have a good understanding of the market fundamentals, but certainly the uranium market at the moment is at its strongest position in the last 15 to 20 years. In fact, today's uranium price at $81 per pound is the highest it's been in the last 15 years. We also believe as a company, and I think a lot of people will agree with us as well, there is significant additional upside to that price moving forward. And we would be very, very confident in stating that we would expect to see something in the order of around $100 per pound price coming through in 2024. We have a proven management team in place, lots of technical experience around redevelopment of projects. The team itself was behind the Boss Resources redevelopment of the Honeymoon project. We've done a lot of good work at Kalakera in terms of optimizing that asset and really driving down those cash costs. And we expect to be able to bring those strong technical skills to the Letlhakane project to be able to optimize that as well. As you might be able to pick up from my accent, I'm from Southern Africa. I've operated and built mines in Africa, as is a number of our leadership team and a number of our directors as well. So I'll just talk a little bit more about the two specific projects. So our primary project, or our first project, is the Kalakera project, which I mentioned is located in Malawi in Southern Africa. We acquired this asset off Paladin Energy in March of 2020. It is a past producing asset. So it was constructed by Paladin in 2008, 2009, and operated for about 5 years. So it shut down in 2014 and went into care and maintenance. It shut down in 2014 primarily due to economic reasons. So if people remember what happened to the spot price post-Fukushima, the spot price crashes at Calacara's operating cost of around $35, $36 per pound. The project was no longer economic, and Paladin made the decision to put the asset in care and maintenance in order to preserve the ore reserve. They kept it in care and maintenance until we acquired the project off them in March of 2020, and we have subsequently kept the asset in care and maintenance as well. However, we have done a lot of work around the redevelopment of that project, which I'll talk a little bit about in one of my later slides, in terms of how we're going to be bringing that project back online again with a target first production date of mid to late 2025. As I mentioned, it's a past producer, and during that period of 2009 to 2014, produced something in the order of 11 million pounds of uranium. That 11 million pounds of uranium was treated at all three of the Western conversion facilities. So that's Converdyn in the USA, Cameco's facility in Canada, and Orano's facility in France. And in fact, in a number of conversations we have had with North American and European utilities, Calacara material has actually been put into a number of these reactors before. So the utilities are very, very familiar with Calacara, both as a project and also Calacara as a product as well. The project has an existing mining license in place, which we recently renewed. It also has all of its environmental permits in place. So as a restart, it's a relatively simple restart for us to be able to do. Now, the Letlhakane project, which is a new project that we've added to the portfolio, we closed that deal in November, on the 7th of November, and that deal was through a scheme of arrangements whereby we acquired all of the shares or the outstanding shares in ACAP Energy. ACAP Energy is an ASX listed company that held the Letlhakane project. So what did we as a company like about Letlhakane? Well, I think the most important thing about Letlhakane is the resource. It is a very, very large resource, 190 million pounds of uranium at around 320 ppm. The project itself has a mining license in place. Through the feasibility work that ACAP did, they were able to get a mining license, which was issued in 2016. In addition to the mining license, it also has an environmental license, and it also has the permits to abstract groundwater and the permits to install water bores as well. I think it's also important to note that the project itself is located very, very close to existing infrastructure. So anyone who knows Botswana knows that Gaborone is the capital of Botswana. The second largest town in Botswana is Francistown. The A2 highway, which connects those two, runs right past the mining lease boundary that we have for Letlhakane. In addition to the sealed road, there's also a railway line that follows that route, and there's actually a railway siding that exists within our mining lease boundary. There is a large substation as well, electrical substation that sits within the mining lease that we can also connect onto for electrical power. And as I mentioned, there's already access to water. So this project ticks a lot of the boxes with regard to access, power, water, and we also recognize that the project is situated in an area in Botswana that does have a historical mining industry as well. If people can remember BCL and Tati, these were companies that had a nickel smelter in the area and associated nickel mines as well. So we do have access to a skilled workforce for that project when we decide to construct and operate that project. I don't want to spend a lot of time on this slide, but I think it's really important to note the latest information coming out of WNA, where they reference what their expectations are with regard to the nuclear power generation and their forecasts going forward. So as of 2022, the amount of power generated by the nuclear industry was around 366 gigawatt equivalent. They're expecting this power generation to increase by around 3.6% per annum. That means that by 2040, we expect to see around 686 gigawatts of electricity generated by nuclear power. But what's interesting for us as a future producer is how much uranium is actually required to be able to feed those reactors. So even today in 2022, when you have a look at how much uranium is required to deliver that 366 gigawatt equivalent, you need around 170 million pounds of uranium. Yet today's primary production, so primary production has been classified as the material coming out of existing mines, is only 130 million pounds. That gap today has been made up by secondary supply, specifically materials coming out of inventory or what they call through the underfeeding in the conversion process. However, when you project those numbers forward and you look forward to 2040, where you're looking at producing that 686 gigawatts of electricity, you need something in the order of 335 million pounds of uranium to be able to do that. Yet today's mines, when you look at their potential production rates in those years, will only be delivering 65 million pounds of uranium. There is a huge, huge gap in terms of the existing mine supply to be able to deliver into the market. And the only way that that material can come into the market is through new mines coming online. And the only way new mines can come online is with a further increase in the uranium price moving forward. So the uranium market is looking very, very positive as we look into the future. How is Lotus going to help resolve this issue? But as I mentioned, Kayelekera has got 51 million pounds. We combine that together with Letlhakani's 190 million pounds. We have a combined resource base of 241 million pounds. But how do we see those pounds coming into the market? Well, the graph there on the bottom right-hand side shows how we want to do that. The blue bars represent the Kayelekera production from our feasibility study that we announced to the market last year. Kayelekera has 7 very, very strong years of production, producing around 2.4 to 2.5 million pounds of uranium. Those last 3 years when the production drops off really relates to the fact that we're moving away from mining material from the pit and actually recovering material from the stockpiles on surface, which naturally have a lower grade than that coming out of the pit. But this is where Letlhakani comes in for the company. We can see Letlhakani coming in and filling that gap and extending the life of the life of production for Lotus. So what we're presenting to the market is that Lotus has the potential to become a company that will be able to deliver somewhere between 2.5 and maybe as high as 4.5 million pounds of uranium for the next 20 to 25 years. And I think that's a great story for our investors, for future shareholders, and also for the utilities that we're speaking to. I just want to do a little bit of comparison against some of our peers as well. And I'll focus here specifically on the ASX. As I mentioned on one of my first slides over there, with the acquisition of Letlhakani, Lotus now becomes the 3rd largest uranium resource on the ASX. Only Deep Yellow and Paladin have more resources than ours. But as you'll see, our market cap, as shown by the blue numbers on the bottom of this graph, is still relatively low compared to Deep Yellow and Paladin's numbers. So we believe there is a significant upside to our share price moving forward. And just to try and show that in a bit more detail as well, this graph over here shows the dollars per pound in the ground valuation of each of the different companies. Lotus as a company considers itself to be a restart or potentially a restart through the Kayelekera asset. And when you look at the other restart companies out there, specifically Boss Energy, Paladin, and even Peninsula, the average dollar per pound for those restart projects is around $8 per pound. Yet Lotus today is only valued at $2 per pound. Again, when you compare that number against developing projects, so those are companies out there that have got greenfield projects, we think we should be somewhere between the average of the developing sites because we have the Letlhakani project and an average of the restart mines because we have Kayelekera. So we were thinking a valuation of somewhere between maybe $4.5 per pound is a real target for us to try and achieve as we move forward. Just to give a really high-level assessment of the economics of Kayelekera. So if we take today's spot price of $81 per pound and we reference back to our feasibility study showed that we had a cash cost of around $30 per pound. An additional $8 to get to our all-in sustaining costs means that we have a profit margin of around $43 per pound. Now, that profit margin, if you assume the 2.4 million pound per annum production rate that I spoke about, means that Kayelekera will produce on an annual basis something in the order of $100 million of EBITDA. Basis, you take that into account when you look at our upfront capex of only $88 million, we have less than 1 year payback for this project moving forward. again, I think a great story for us to be getting out into the market. I just want to talk a little bit about the next steps as well for the two projects. So obviously Kalakera, the most advanced of our two projects, has the infrastructure on site there, is really quite a quick restart for us. What are we doing now in terms of being able to bring this project back online again? Well, we've always been waiting for the uranium price to reach a level that makes economic sense for us to turn this project back on again. We are now at a level where it makes sense for us to bring Kalakera back online again. However, there are a few things that we would like to do or achieve before we make final investment decision. And those things are really around some of the key activities that we undertook in the feasibility study, specifically around getting a power supply agreements in place with Eskom. Eskom is the Malawian utility there. We need to try and connect the plant to the national grid so that we can get a lower electricity price for the restart. We're also busy with the government negotiating mine development agreements. Now, mine development agreement is a very common agreement that you have in Africa, whereby you set the fiscal regime in which the project will operate. So that means tax rates, royalty rates, and those types of things. We've been busy with the government on that, and we're getting close to being able to finalize those. And hopefully we'll be able to announce to the market in the next few months the successful completion of that MDA negotiation. In addition to those agreements with Eskom and the government, we're also obviously busy with offtake. We're talking to a lot of utilities about signing some offtake. We're also starting to have a look now about operational readiness, kicking off a front-end engineering and design program, which will run into detailed engineering, really to go back and refresh that capital number, make sure that $88 million worth of upfront capital is still the real number we want to work to, go back and check that cash cost as well, that $29 per pound, and also reconfirm the timeline required to bring this asset back online again. Our feasibility study indicated around 15 months for us to be able to refurbish this plant. We just want to go back and check that item, as well as look at the long lead items we may need to acquire in order to achieve that timeline. So a lot of work around Kalakera over the next few months, and hopefully we'll be reporting back to the market on the advancement of those various areas. Our second project, Letlhakane, a lot of work we want to do around this project as well. There's obviously the process. We've just closed out the deal, so we're currently busy working on integrating the various technical and management teams together. But really, we want to start on some of the technical work that we identified during our due diligence exercise as to how we can try and optimize this project to be able to develop it. And the first phase of that work is really around the resource. We believe there's a real opportunity to go back and have a look at that resource modeling, tighten up some of the constraints within it, to really focus on trying to get a resource with a higher grade. Currently, Letlhakane has an average resource grade of 320 for the 190 million pounds. We would really like to try and focus on getting that average grade up, even if it means losing some of those pounds. So we're going to be busy working on that over the next couple of months. At the same time, we recognize there's a real opportunity to undertake some beneficiation test work at Letlhakane. We were very, very successful at Kalakera in terms of applying what they call optical ore sorting to try and improve the average grade of the material being fed into the mill. And we think something similar can be done at Letlhakane as well. So fortunately, ACAP, the previous owners, had done a very, very good metallurgical drill program, collecting a number of core samples that can be used for this metallurgical test work. Those met samples are now at labs in South Africa, and we're just about to start this beneficiation test work to see what we can do. Ultimately, what we would like to achieve through our new resource modeling and through what we're doing on the beneficiation test work is it possible to be able to generate from the Letlhakane deposit a feed material to the mill that is in excess of 500 ppm. We believe if we can do that, we could then look at duplicating the Kalakera processing plant at Letlhakane. So that's a crushing, milling, tank leach, resin and pulp, and elution process. If we're able to duplicate the Kalakera circuit at Letlhakane, we think it gives us significant advantage in terms of being able to develop that project, because obviously we'll have all the experience from operating Kalakera, and we can apply all that experience and all that knowledge to the Letlhakane project as well. I think there's also an opportunity for us to go back and have a look at the resource. We do recognize there is a lot of material sitting in the inferred status. We need to do an infill drill program in order to be able to convert that to measured and indicated, such that we can then wrap an economic study around that project and demonstrate to the market how we see it being developed. However, I would add that I do think it's important that we try and get out to the market as soon as we can, a small scoping study that really shows the market how we intend to develop this project moving forward. And that scoping study, I think, will be done based on the new resource model and the beneficiation test work that we've done. So lots of good news flow coming out of Letlhakane as well. So we expect to have a really busy 12 months ahead of us for Lotus. So that's the end of my presentation. I'm happy to take any questions that the audience may have. So I see one coming up over here is with regard to Malawi and what is the mining industry like in Malawi? Well, mining in Malawi is still in its infancy. In fact, Kalakhera as a project was the only, or as an asset, an operation, was actually the only commercial scale operation that has ever been in operation in Malawi. From that perspective, Malawi is still developing its mining industry. We do know, however, that Malawi is very, very engaged in terms of trying to develop this industry. People may be aware that Malawi itself is a very poor country, and the government is definitely looking at the mining industry as being a mechanism to try and generate significant economic growth for the company. So there is a lot of support from the government for Kalakhera to restart. And we also recognize at the same time there are a significant number of other companies, specifically Australian companies, that are in Malawi looking to develop mining projects as well. So we think there's a bright, bright future for Malawi going forward with regard to the mining industry. And we're certainly getting that feedback from the various government officials as well. So the MDA, as I said, is an important part of those discussions, and we are making some good progress around that as well. Just in terms of some other questions that are coming through, so I see there's a comment there with regard to how inflation is impacting on our costs. As I think I mentioned in the presentation, the feasibility study that we put out to the market in August of last year is obviously was over a year old now. It's important for us to go back and refresh those costs. That will be done as part of the feed program that I mentioned. But really, when you look back at when we did that feasibility study, we were collecting the costs then in June and July of 2022. I think people will remember back then, inflation was running rampant. Freight costs for various things were exorbitant at that stage. So we don't see a significant change in either our capital cost, and in fact, we might even see a slight reduction in our operating costs because of that reduction in freight. However, we will be generating or going back and having a look at those numbers as part of our feed program, and we'll be able to present them back to the market. But as I said, we don't expect to see a significant change in those numbers going forward. And then maybe just as a last question here as well, it's a common question I get, and this is regard with workforce, skills, or the availability of skills to be able to develop these projects. I think the first comment I'll make is that obviously Kalakhera is our primary project. That's the project that we'd like to see up and running, as I mentioned, with producing in 2025. We are fortunate within the Malawian context that because this was a past producer, there are a large number of previous employees that are currently still in Malawi that are looking to come back and work at the mine. And in fact, when we took over the asset and started to talk about restarts, a large number of these people approached the company saying that they would be keen to come back again. So we think a significant portion of our local workforce we will be able to get from these past employees, giving us a real advantage in terms of not having as much training to be able to do to get these guys back up to speed again. We've also seen, surprisingly, from the expats. So having had a large expat contingent when Kalakhera was operating previously, and our recognition that we still need to maintain at least some expats on the operation when we restart, there are a number of the expats who previously worked at the mine who've also come back and said that they would be interested in coming back to Kalakhera. I think that's really interesting, and I think it's based on the fact that Kalakhera, in terms of its location, is a relatively easy operation to get to, especially for an expat who's based in South Africa and around Joburg. In fact, there would be a direct flight, a charter flight that would go from Johannesburg to Karonga, which is the nearest town to the mine, And from there's only about a half an hour drive to the mine site. So relatively easy in and out for any expats compared to some of these guys who are unfortunately working in Middle and Central Africa or even in the Middle East, where they've got many, many days of travel to be able to get to their mines. So we feel we've got some advantages when we're looking at skilled workforce that we think will certainly give us an advantage as we move forward. And just one last comment on Letlhakane as well. So Letlhakane, we do have a lot of development work that we want to see coming on. We would only see Letlhakane starting up in probably 2029 or maybe 2030. So I think there's a bit of time there to have a look at what we require from the workforce. I think those are the main questions that I've got. So with that, thank you.